Are you tired of watching 30% of your portfolio disappear in just 3 months? You followed all the expert advice, bought the safe index funds, but your $5,000 investment is now worth $3,500. The frustration is real, and you're starting to think investing just isn't for you. Here's what's really scary. Every day you delay fixing these mistakes, compound interest is working against you instead of for you. The difference between starting to invest correctly at 22 versus 32 could literally cost you hundreds of thousands of dollars. But here's the good news. The 3 growth areas I'm about to share aren't just theory. They're the exact shifts that turned my own investment losses around. And they work whether you're starting with $100 or $10,000. So let's dive in. Growth Area 1. From reactive to strategic thinking. The first growth area is shifting your mindset from reactive gambling to strategic thinking. Here's what I mean. So many new investors get burned because they treat the stock market like a casino. They chase hot stocks they hear about on TikTok, hoping for a quick 500% return. That's FOMO in action, and it's a wealth killer. The fix? Start thinking like a business owner, not a gambler. When you buy a stock, you're buying a piece of a real business. Would you buy a local coffee shop without understanding how it makes money, who its customers are, or what its growth prospects look like? Of course not. Successful investing is about having the discipline to stick to a well-defined strategy and resist the temptation to react to every market headline. The goal isn't to perfectly time the market. It's about giving solid companies time to compound your wealth over years, not days. Growth Area 2. From single bets to systematic wealth building. The second growth area is moving from making single bets to building a systematic wealth building machine. Here's the brutal truth. Putting all your money into just 1 or 2 investments is financial suicide. If that one company you bet everything on fails, your entire financial future goes down with it. I see this mistake constantly. Someone puts their entire $10,000 into Tesla because they believe in electric vehicles, then watches helplessly as their portfolio swings 40% up and down based on Elon Musk's latest tweet. That's not investing. That's gambling with your future. The solution is diversification, but not the boring kind you hear about everywhere. I'm talking about building a systematic approach that works while you sleep. For most people starting out, low-cost index funds are your best friend. With one purchase, you own pieces of hundreds of companies across different industries and countries. But here's the real game changer: dollar cost averaging. This means investing a fixed amount every month, whether the market is up or down. When prices are high, you buy fewer shares. When they're low, you buy more. Over time, this smooths out your average cost and removes emotion from the equation completely. The goal isn't to get rich quick. It's to build a resilient system that compounds your wealth steadily over decades. Growth Area 3. From following trends to building knowledge. The third and final growth area is shifting from blindly following trends to becoming an informed investor. We're constantly bombarded with stock tips from Instagram influencers, YouTube ads, and so-called experts, promising the next 1,000% return. Here's what I wish someone had told me earlier. Every time you invest based on someone else's hype without doing your own research, you're essentially gambling with your future. You don't know why you bought it, so you don't know when to sell it. The fix is simple but powerful. Commit to understanding what you own. You don't need to become a financial analyst, but you should be able to answer these basic questions. What does this company actually do? How do they make money? Do they have a competitive advantage that will last? Are they profitable and growing? This takes maybe 30 minutes of research per investment, but it will put you ahead of 90% of investors who are just chasing the latest trend. Being an informed investor also means being aware of your own biases. The most dangerous one is confirmation bias, only seeking information that confirms what you already believe. To combat this, actively look for reasons why an investment might fail, not just why it might succeed. Let's recap these 3 growth areas that will transform your investing. First, shift from reactive gambling to strategic thinking. Second, move from single bets to systematic wealth building through diversification. Third, shift from following trends to building your own knowledge. Making these 3 shifts will fundamentally change your relationship with money and investing. It will move you from a state of fear and frustration to one of confidence and control. Remember, investing is a marathon, not a sprint. And with the right approach, you can turn past losses into a powerful engine for long-term financial freedom. If this video helped you take control of your financial future, smash that subscribe button and turn on notifications. Growth Minded is here to guide ambitious minds like yours toward real wealth. What's the biggest investment mistake that's been holding you back? Drop it in the comments. Let's learn and grow together. This is Growth Minded.